it has been for the markets. I mean, not just us as much, but more so the global markets, because they, after a bit of turbulence about a fortnight back, have come back with a vengeance. So net result, you had the S&P 500 index eke out almost a 4% gain, and the Nasdaq jumped up over 5%. So globally, things seem to be stabilizing for sure. It was no different for even the UK markets, with the FTSE jumping up nearly 2%. And in that context, it seems like we were the underperformers, because the Nifty, even though the headline number is not going to give you any reason to complain, we're looking quite pretty at there, but we managed a less than 1% gain. But yeah, globally, things seem to be back with a vengeance.
See, I will not read too much into the India performance. Why? Because we fell the least. Since you'd fallen the least, obviously the recovery is not going to be really the best also, so to speak. But what really matters to me is this screen, and then we'll supplement it one more data point. That imagine you went on a 15-day holiday and you came back and said, okay, let's look at the market. Now, it's extraordinary to see that the force with which markets have made a comeback. Now look at VIX here. It went from 14 to 30 plus. Actually, on an intraday basis, it was nearly 50, and then it is currently at 14. That's the India VIX for you. The CBOE VIX, which is the global indicator, was at 23, went to 65. Now it has 14. And the US 10-year paper, despite this turbulence, the yen carry trade, all the hullabaloo which happened around it, went from 3.7 to 4.7. 4.7 was, I mean, not because of this event, that's the real peak. And now it is settling at 3.8. The point I'm trying to make here is that globally, it was like a bad 2-3 day window, and the force and the vigor with which equity markets globally have made a comeback, it is quite extraordinary. VIX has got crushed. The leadership in some of the US stocks, I think, is evident, and the risk-off fear, which in a sense had really had a snowball effect on all other asset classes, that is clearly behind us. So imagine if you went on a 2-week holiday and you come back and see the market, trust me, nothing has changed, and that's the force of the market. It's global in nature, and it is not really the local picture which is important.
Yeah, absolutely. So within a couple of weeks, we are back to status quo, and it's all about earnings, fundamentals, momentum, and liquidity, which has been driving the Indian markets. Of course, just taking a quick look at the F&O snapshot and the FII data as well, because incidentally on Friday, we did see a buy figure coming in from FIIs after a while. So it was a 800 crore, less than 800 crore buy figure, but nonetheless something to watch out for. And the DIIs, they continue to buy with a number of around 2,606 crore. On an F&O snapshot basis, there was a bit of short covering on Friday for Nifty and Nifty Bank, and now the FII long short position stands even Steven at 50-50, so just tracking that. But talking about tracking, there are a lot of important events lined up later in the week that we need to keep on our radar. Of course, the PMI data comes out, the manufacturing and services PMI data for India, so that remains important. Globally, it's the FOMC minutes that one needs to track, and that is something which is very important, because that comes in the context of the Jackson Hole Summit, which will be underway starting this week itself. So a lot of central bankers, not just Jay Powell, but others as well from across the globe, will be speaking at that event. We'll also get the US initial jobless claims data, important to track, because that will tell you how the trajectory is going to move forward with respect to the US rate cuts as well. There are a couple of IPOs lined up, smaller ones at that, Interarch as well as Orient Tech, etc. So watching out for those things, but nothing which is very groundbreaking as far as this week is concerned.
So Nisha, it really, events do not matter in the kind of market setup we are in. What really matters is the trajectory. And if you're really looking at the market from the lens of where we are headed in the short term, it is very global in nature. And then Indian markets are simply piggybacking on that. B, the construct of the market locally also, we are almost at an all-time high. Volumes have been strong. More and more mid-cap stocks are chipping in, with the exception of, let's say, 2 or 3 large sectors like a defense, railways, few PSU names here or there. This market has a lot of momentum. So unlike what appeared 2 weeks ago, that, okay, this market is going to come down because of the global push and because of the risk-off moment, that has not translated into reality. So if you are invested in the market, well, you stay invested in this market. There is no point in being bearish for the sake of being bearish. Lot has been thrown at our markets in last 3 months. Election outcome, budget, global volatility, but markets have ignored that. And I think that in a sense is a proof of what the near-term demand-supply equation is. So you can be bearish, you can cry foul about valuations, you can keep on making a case that okay, this is not going to sustain, these are not the levels at which you want to invest. I buy all that and I hear all that, but all that argument is not making that argument is actually not making money. So the best way is that you stay with the momentum, you get slightly more and more selective about where you are investing right now. Like the churn which we mentioned is visible in new age stocks, it is visible in some of the consumer staple stocks, and that is what you need to identify now, because the strength in global market is so strong that you just don't want to go against it.
If you like this video, then like, share and subscribe to ET Now.